Hello and welcome to Africa Business Weekly. I'm Aki Obake. On this episode, we'll bring you key discussions shaping the business landscape in Africa. But let's get a sense of what to expect on the show today. We start off in South Africa, where markets are beginning to react positively to the government's medium-term budget policy statement. We discuss highlights with a panel of experts. And in East Africa, Rwanda Stock Exchange introduces a green exchange to promote green, social and sustainability-linked investment. And in West Africa, S&P Ratings shares insight into Ghana's economic outlook after its latest sovereign credit rating upgrade. Let's get right into the show. Karabo, bring us up to speed with stories from your region.
Hello, Akin. Well, South African markets reacted favorably to Finance Minister Godongwana's medium-term budget policy statement on Wednesday, with the rand strengthening to its strongest level since February of 2023. Among the minister's announcements was that the inflation targets would be lowered to 3%, with a 1 percentage point band to provide quote-unquote flexibility to accommodate any unexpected inflationary shocks. For more, CNBC Africa spoke to a panel of experts, including Casey Sprague, economist at Anchor Capital, Nikki Wima, who is the chief economist at Nedbank, as well as Simpiwe de Tlojane, who is the head of investment strategy at Absa Investments.
At a simple level, this year's statement carried a much more measured and credible tone, and that's really been supported by improved sort of in-year fiscal performance and broader consultation within the government of national unity as well. I mean, that stands in direct contrast to what we saw with the main budget towards the beginning of the year. And I think the net result of that was a much more market-friendly and coordinated message. And that's really signaled sort of greater fiscal discipline and institutional coherence between both Treasury and, of course, the SARB as well. And that's gone down very positively in the market. So the minister's confidence was well vetted, I would say.
Sure. I mean, some of the things that he announced, as you said, the fiscal picture looking a little bit better, revenue exceeding initial projections, spending also coming down. In fact, the minister talking about fiscal discipline for the first time since 2008 is what would be achieved on top of all the other structural reforms from energy to logistics that he did mention as, having teed up the economy in better form and footing, as it were. Simpiwe, sir, your key takeaway from the budget and, whether the euphoria that we seem to be seeing across the markets right now from the JSE and slightly even in the currency market is as a read-through from the better picture of South Africa's economy that has been presented.
Yeah, certainly. I think this budget does speak to quite a lot of success on government's front in terms of containment of debt and fiscal consolidation overall. I think they have made great strides there in terms of, of course, we're going to be seeing debt to GDP peaking in the current fiscal year. And we've seen quite a significant scaling back of debt servicing costs, which have really caused quite a bit of a drag on our overall spending propensities over the past couple of years. So a lot of that really being quite positive. And then, of course, what we're hoping for is that as we see this debt containment, as we see some money freeing up, as we see primary surpluses as well, that begins to, give us room to start directing spending towards growth enhancing initiatives. So economic development and the likes.
Yeah, because Nikki, just to bring you in as well, I mean, the minister presented this and he spoke about this being a budget of growth, a budget of stability and a budget of reform. And I'd like your take on whether you reckon he managed to successfully achieve that based on what he presented.
Well, I think this is a plan, right? So one should always bear that in mind. If we look at the numbers, they've broadly stuck to the path they set out in May. There aren't any dramatically different figures. There's clearly quite a lot of intent signified in this budget on the expenditure side, where they have a very significant slowdown in expenditure growth, and that obviously helps them to meet the sort of deficit reduction path they set out in May, and this one is only slightly better than that. I suppose the emphasis here is that they are starting to show progress on structural reforms, and there's clearly a plan to accelerate infrastructure spending. There isn't, as of yet, in this particular fiscal year, really overwhelming evidence that we've seen a significant acceleration in infrastructure spending by government.
South Africa's unemployment rate has fallen to 31.9% in the third quarter, with the country adding 248,000 jobs from the second to the third quarter. Analysts found this uptick heartening but remain cautiously optimistic, taking into account the broader context of South Africa's employment challenges. For more, CNBC Africa spoke to Lisette Isil de Skepa, Chief Economist of the Bureau for Economic Research.
So the QLFS data was perhaps a little bit better than we anticipated. We saw relatively strong quarter-on-quarter job growth, 248,000 jobs added in the third quarter relative to the second quarter. We saw a decline in the number of unemployed people in the South African economy. So if you take those together, you actually see a dip in the unemployment rate. Now, it remains high at 31.9%, but it's lower than what we've seen in the last couple of quarters. It's too early to say whether we're moving in the right direction, but at least this print is quite encouraging.
And when we look at it, we've got to look at the additional numbers of people counted. So discouraged job seekers, those who make themselves available for jobs, those who are available but make themselves unavailable for jobs. Are we getting a better reading in this set?
Yeah, so Statistics South Africa made quite significant changes to the way they measure both people that are employed but perhaps not working to their full capacity, but also people outside of the labor market, and that could potentially, or outside the labor force rather, and could potentially be in the labor force. So remember, to be counted to be as an unemployed, you need to be actively seeking for work, and you need to be actively wanting to work and accepting a job if one is offered. Now, we know plenty of people in South Africa are not in that position. Some of them are studying, they don't want to work. Some of us, some have just given up looking for work, these so-called discouraged workers. So with the new data, Stats SA is sort of breaking up these potential labor force participants in a lot more detail. So obviously this is the first release of this, and it will take time to study this, but it will give us a better indication of how people are shifting in the labor market, how people might be getting a bit more excited about looking for work if we see economic growth picking up, for example, so you can hopefully better anticipate trends going forward with this data.
And it's also better because now when we talk about unemployment shift, we're looking at the unemployment rate falling, and if I'm correct, we're also looking at it reflecting not only more employment but fewer people being classified as unemployed. So if fewer people are being classified as unemployed, what are we, besides those who have just given up, they're not looking and they're not working, are we starting to take into account those who are making money but not counting themselves as employed or making a living?
Yeah, so it's always tricky. The quarterly labor force survey is exactly what it is, a survey. So Stats SA goes around and asks people, are you employed? Are you earning a living? Now, we know that sometimes people might not be honest when they respond to a survey, but I do think that this survey has a better way of capturing this so-called economic activity that is taking place in the informal sector that isn't seen as sort of a normal typical job. So I think it will take some time to disentangle the trends. I mean, the longer term informal data series still needs to be built. We can't necessarily compare today's data to the second quarter data, so it's difficult to see how things are changing. But it is hopefully over time going to give us a better idea of these shifts and sort of economically active people, but not necessarily in the easily captured formal sector.
And those were just a few of the stories making headlines in Southern Africa for this week. But until then, it's back to you, Akin.
Many thanks there, Karabo. A beautiful evening to you, Ridima. What's cooking in East Africa?
Hello, Akin. The Rwanda Stock Exchange introduced a green exchange window this month during the ASEA conference in Kigali to promote green, social and sustainability-linked investments in the country. The initiative is developed with the Luxembourg Stock Exchange and aims to attract funding for climate-resilient projects and strengthen Rwanda's position as a regional hub for sustainable finance. We spoke to the RSE CEO, Celestine Rwabakumba, for more. Take a look.
I think it's the moment for everyone, in particular Africa. You know very well we are the ones who are affected by climate change more than anybody else on the planet. Although we are not the ones who pollute most, but you know we must follow suit because it's very important for us. Yeah, it's our time.
All right.
That's the time. Actually, it's the time.
Well, many are asking, what does this green exchange window hope to present to Rwandans as well as East Africans when it comes to having a platform where they can invest in the green products?
Well, the green exchange window comes to complete our menu of offerings. Again, like I said, you know, the green finance and sustainable finance is here to stay. We are implementing, it's part of our bigger picture of as Rwanda, you know, as we try to become, we are trying to become an international financial center under the KIFC. Yeah. So we have created the roadmap as a country, and green and sustainable finance is part of it, and the stock exchange cannot be left behind, because as a stock exchange we are part and parcel, or at the center actually of that development. So you've seen a few products coming on the market recently, and some green bonds, the green sustainability linked bonds coming onto the market to support our economy in complying to the new trend.
And looking at this initiative, how will it redefine the products that you are offering at the RSC, and how soon will it go live?
Well, I mean, the platform basically, you know, it's going to be, first of all, you have to know the objectives. You know, it's now to put it in a more formal way, because, I mean, the demand is there for green products.
Yes.
And the whole idea is to unlock capital from the investors who prefer investing nowadays more and more in sustainable projects, so sustainability compliant projects and green projects in general. So so for us is to formalize what actually is already happening on the ground. So the few products that have been coming on board, we accommodate them because we have we follow best practice internationally, but now we want a place, we want for them a home where people can come and explore the opportunities that this green space offers, and they get also the services. You know, that is capacity building, that is product offerings, and so on. So I think that's the main objective, to have it as another market segment on the stock exchange, because that's a standard practice elsewhere. Yeah.
Well, speaking about standard practice elsewhere, the Luxembourg exchange has had a successful run at this, and I'd like to know, how do you see this improving transparency as well as accountability when it comes to tapping into the roadmap that Rwanda has put in place when it comes to deepening capital markets through ensuring that there are various products available?
I think, you know, transparency is very key. I believe the market in Luxembourg has built its trust from investors and issuers across the globe. Most companies which are listed there, in thousands of instruments which are already listed in Luxembourg on the LGX. So they have built their trust on that, the transparency and that comes with it.
Just today, Kenya Electricity Generating Company PLC has reported solid financial results for the year ended June 30th, 2025, as after-tax profits were up 54%. The listed power utility firm saw net profits hit 10.48 billion Kenyan shillings compared with 6.80 billion Kenyan shillings recorded in 2024. The company attributes the good performance to stronger operational efficiency, cost optimization, and increased generation from its diversified energy portfolio. CNBC Africa's Abby Agina spoke to the CEO, Peter Zhenge.
Very happy to have these very wonderful results the past financial year. Just to confirm, I'm Engineer Peter Njenga, the Managing Director and CEO of KenGen PLC. And KenGen is the East African's largest electricity power producer, and we are among the top 10 largest producers of geothermal energy in the world. And as a company, we are listed in the Nairobi Securities Exchange, and KenGen is strong not only on energy generation, but also keen on shareholder value creation, sustainability, and climate action. Today, we have an installed capacity of 1,786 megawatts, and this is mostly from renewable sources, hydro 47%, geothermal 42%, and wind 1%. 90% of our generation portfolio is from renewable sources, and the balance, of course, 10% from thermal, from fossil fuels. We are happy with these results, and we can say that these results, if we look at the operating environment, Kenya's economy has maintained a steady growth, supported by strong agriculture, ongoing infrastructure development, and expanding industry activities. The national electricity demand hit a record peak of 2,411.98 megawatts, and this was recorded on 24th of October, 2025. And this reflects a rising economic activity. KenGen continued to anchor Kenya's energy sector, supplying 59% of the country's electricity consumption in the last financial year. The total installed capacity of 1786 megawatts generated 8,482 gigawatt hours in that year.
All right, and quite impressive numbers there. But looking at the next area I'm keen on to get your thoughts on is in regards to upcoming projects. You did illustrate that there's been demand for energy has been growing in the country, and I just want to know what are some of the next set of areas that you're looking at generating more power as well as more income?
Thank you very much. We have come up with a strategy for the next 10 years, which will run to the year 2034. And we are targeting to add an additional 1,500 megawatts of new generation capacity, along with 500 megawatt hours of energy storage. And our aspiration is to achieve a fully renewable energy portfolio with the planned capacities that will be including 840 megawatts of geothermal, 140 megawatts of hydro, 370 megawatts from solar and wind, which we refer to as a variable renewables. And we are also going to optimize the existing assets and get an extra 150 megawatts. We are in discussions with the Ministry of Energy also regarding a potential investment in a 700 megawatts hydropower plant. That is in addition to the 1,500 megawatts. The planned energy storage capacity we are going to deliver through battery energy storage systems and also pumped hydro solutions. But we are also looking at any other new forms of storage.
Those were some of the biggest stories from East Africa this week. Back to you, Akin.
And now to stories from West Africa. We'll start off with stories from Ghana, where S&P Ratings says the country's economy remains exposed to risks from commodity price fluctuations and broader external and weather-related shocks, despite stronger recent economic outturns. It also raised its long and short-term foreign and local currency sovereign credit ratings on Ghana to B-B with a stable outlook. Ravi Bhatia, sovereign credit analyst at S&P Global Ratings, unpacked this development.
Indeed, last Friday, we raised our ratings on Ghana to B- from CCC+. And that reflects the fact that they've made actually quite a lot of progress on restructuring their bank loans, commercial bank loans, essentially. Because if you recall, they had earlier restructured their bonds. They've had agreements with bilateral lenders. So, we took them out of the bonds out of SD in October last year. And then in May, we took Ghana out of SD onto CCC+. And now we've seen substantial progress on the restructuring, the tail end of the restructuring. They're working on the bank loans, commercial bank loans in particular, and they've moved forward on that. So we've taken them up to B-. But we're also seeing that the economy is doing much better. Part of it is, as you said, tied to commodities. I mean, gold prices are very high, and of course, Ghana is the old gold coast and produces a lot of gold. But cocoa has also been doing well, and the oil sector also, has been doing reasonably well. So there is the commodity side, but also domestic demand has done quite well. So the economy is rebounding, and with the new government, they're really focusing on fiscal consolidation. They were faced with a fiscal blowout, last year, but now they've really pushed on the path to fiscal consolidation. So we took that into account as well. So basically, growth across the board, movements on the restructuring, and also improvement on the fiscal side.
Let me take you on the fiscal outcomes, and then, like you rightly said, election here is also going to be another litmus service, another litmus test in terms of looking at how valid and how strong this fiscal consolidations have been so far. But let's look at how the monetary consolidation is also playing out. We're seeing the NPR rate also dropping. We're seeing inflation fall to a staggering low, and then all these indicators shows how well Ghana is faring. But let's look at what you think in terms of the mid to short term now.
The prospects are really across the board good. It is finally that inflation is coming down. They're getting a grip on inflation. The currency story, the city has been doing well, so they're not faced with the earlier problems that they had of high inflation and the significant pressures on the currency. So we've seen a turnaround on that. As mentioned, it's partly tied to gold and commodities, which are doing better, but it's also a broad-based recovery. This is helping domestic demand, which is helping growth. And so we've actually revised our growth numbers up for this year. And we're looking at, at least around 5% growth. And that's higher than what we had penciled in May of this year when we last reviewed Ghana. So they're doing well. And then that supports them on the fiscal front. And they also have a number of fiscal rules that they want to implement.
To the Nigerian economy, Biodun Adedipe, founder and chief consultant at BAA Consult, says the economy is in a better place than it was a year ago, and some measures of trickle-down is happening and needs to be deepened to become widely felt. This comes just after the IMF consultation mission opened discussions on Nigeria's economic reforms in Abuja to review policy priorities and reform direction ahead of its next country report on Nigeria. Take a listen.
First, from the statement made there, that if you look at where the Nigerian economy is today, November 2025, it's better than where it was a year ago, November 2024, and for very good reasons in terms of what has happened to the macroeconomic indices, the major ones, and also what has also happened in terms of the response to what we normally saw historically as pressures coming from the international, economic environment. And I particularly speak to what happened in July this year, which in fact was the first time we'll experience that in our economic history. And that it speaks to the usual relationship between the price of hydrocarbons, especially crude oil, and the exchange value of the naira. Now, historically, anytime the price of Nigeria's major reference crude, Bonny Light, dampened, the naira lost value historically. But that did not happen in July this year, when there was this, exchange of nukes between Iran and Israel. And then there was this apprehension in the oil market globally, and so prices started going up. And then when the US intervened and the war ended abruptly, prices of crude oil dampened significantly. Some losing close to $10, per barrel. Some above $70 per barrel, dropped to about 62, 61.
But what would you say is responsible for that resilience?
Yeah, exactly. That's where we are going. Now, what, in my own estimation, was responsible for that resilience proven is because the structure of our foreign trade has changed somewhat. Number one is the composition of our merchandise imports. Then the second part to it is that we have seen a situation where non-oil exports have also strengthened between 2024 and it's up to half year 2025 based on data available. So when you look at all of that, they provided some cushion and of course play that against the very high monetary policy rate, then at 27.5%, and of course making Naira assets attractive and therefore attracted inflows. So creating some measure of liquidity in the foreign exchange market.
Yeah, because
so the interplay of all of this helped to change that narrative.
Yeah, because we love to talk about structural distortions in the market here, but then you still alluding to the fact that we're still seeing some of these critical indices trending positively. Yeah. You know, let's get into that a little bit. Yes, inflation was one of the big key ones, yes, you know, that we're seeing here, but IMF would let you know that yes, we've seen progress encouraging, but we're still seeing inflation above 20%.
Well, okay, latest data for September 2025 at 18.02%. But looking at 34%, you know, much earlier in the year, that is some measure of improvement. Yeah. But what is even more interesting there is the expected inflation. Yeah. So which, of course, if you look at what drove that dampening and ask yourself whether this is likely to be sustained for the rest of the year, the answer will be yes. You know, because, again, we've seen in Nigeria now, the harvest period has extended beyond July and August for staple foods in Nigeria, which of course showed in our inflation figures for July, August 2024, where the rate dampened before it went up in September with not really correct pricing of electricity. So now, if you look at what has happened this time around, harvest period has extended beyond July, August for staples in Nigeria. So, and that again, of course, shows in the food inflation, which also dropped significantly. And in fact, accounts for the drop in inflation rate of the headline of 18.02 that we talk about today.
And that's all we can take on this episode. You can catch all these stories and more on our website on cnbcafrica.com. Thank you for joining us today. Until next time, stay informed and stay ahead with Africa Business Weekly. I'm Akin Obakeye, and we'll see you again same time next week.